You'll have to call Ann.
Brian might have had the shortest presentation today, right?
They normally just hand the football to the referee.
I was going to say.
Chris,
Yeah.
Chris, they normally
do have
just hand the ball to the referee. They don't spike it in the end zone. They don't do that kind of stuff. They don't do that. Yep, that's what they say.
Long drive.
Okay, so we'll go, now we are at the semi-annual reports. Alan, item 13 is the open session semi-annual report. Alan Emkin.
Mr. Chairman, members, Alan Emkin, PCA. And it's just important to keep in mind, you get regular updates from your staff on a monthly basis. There's no good reason for us to regurgitate that or do exactly the same thing. So the goal is to try to take a different spin on it. And additionally, the staff had requested, I think it's a request of the board, that there be a very abbreviated one-page summary of our report, which is in this. And if you have any comments or suggestions on how to change that, we'd look forward to that. So what's important from our perspective? What's really important is that over the 6 months, the portfolio grew by over $17 billion. Over the year, the portfolio grew by over $27 billion. And keep in mind that $600 million a month is flowing out net. So that means on an annual basis, $4 billion, which is going out, isn't compounding. And it isn't compounding at 7%. And that's a big number that's not going to compound for 30 or 40 years. And it's just very important that we recognize that cash flow, negative cash flow, is something that needs to be monitored and managed, and that's something that your staff spends a lot of time on. The single biggest factor in investment performance for large institutional portfolios is asset allocation. Towards that, the fund is close to targets in all areas, and in fact, the staff, to their credit, took profits from the public equity portfolio and reinvested that money in your risk mitigation strategy and funded that at its level now where it's now at target, ahead of schedule. And hats off to them for two things. Number one, taking money off the table, but also reducing risk in the overall investment portfolio. A year from now, if I'm lucky enough to be here to give you this report, it's going to be a very different report because the report's a 10-year number. And a year from now, 2008 will no longer be in the 10-year number. The single worst year in my career will no longer be there. So literally all of your trailing numbers, absent a significant loss similar to what you had in 2008, all of those trailing numbers will be higher. And it'll be significantly higher. And I think optically that's great. But it does present a challenge because no matter how good investment performance may be, the way that the fund will become sound is through increased contributions. Investments alone will not fill the void. Over 10 years, the portfolio had a compound return of 5.5%, significantly less than your actuarial interest rate assumption, particularly when you consider for most of that period, the assumption was 8%. It wasn't 7.5 or 7. That doesn't help your funded position. A year from now, that number will not be 5.5%. Barring something totally unexpected, it will be significantly higher than that. Versus your peers, over the long term, you slightly trail, in large part because of 2008. In shorter periods since then, versus policy and versus your peers, your portfolio has done extraordinarily well, particularly since you are so large, and being large, although it has certain benefits, has some real detractors. You just can't do some of the things a smaller investor can do. And most importantly, the staff implemented your policy. You said you wanted to diversify and diversify through risk mitigation strategies, and to their credit, they did that in a systematic and disciplined and very creative way. And the team that put that together deserves a lot of credit. The most important thing, in our opinion, is that you've been disciplined. The staff is aggressively looking at new business models, and the portfolio is performing better than could be expected, with value added almost across the board. And with that, I'll be happy to answer any questions, Mr. Chairman.
Thank you, Alan. Appreciate that. Any questions for Alan? Thank you. Mika, were you going to weigh in?
The only thing that I wanted to add, I think, in this just layers onto what Alan shared in terms of the performance. I mean, obviously 2017 was a banner year, so 16.8% is something to be very proud of for the fund. And I think that I would just reiterate that that move away from some of the global equity portfolio, taking those profits and reinvesting in the RMS strategy, will be increasingly important as the volatility that we saw in February either increases or we just stay at more normal, a more normal level of volatility in the markets. And so I think that it's been a really strong move. And I think that while the performance of that category may not impress you on absolute terms for 2017, I think it will be an ever increasingly important part of your portfolio going forward.
I just wanted to add, Harry, and echo Alan's comments, for especially our teachers in the back of the room. We've made a conscious decision in the reporting to de-emphasize the 6-month time period because we have a 30-year horizon, and 6 months is literally a blink of an eye. So the December report, as Alan said, is 1 page. The full report is still there. It's the hyperlink. So obviously, if you're reading it on paper, that doesn't help you, but go on a computer, and in that paragraph, we will always hyperlink the full book, which is available and is out there for the public, for the teacher members that want to read that. Then at June 30, which will now be presented, I think, at the September meeting, you'll have the full book with all your information like you normally would get. So we're really trying to embrace that idea that we have a long-term perspective. I appreciate PCA's turned their charts around, so the longest period is first, the shortest period is at the end. So you're really focusing on 5-10-year intervals, trying to think long-term, which I know is hard to do in this day and age.
Thanks. Okay, thank you. Brings us to section B, which is to receive the semi-annual performance report period ending September 30th, 2017 for real estate. So representatives from RCLCO, Gadi Kaufman, Taylor Mayman, and Robert Charles Lesser. Welcome, gentlemen. First time in front of the full committee.
So we met 2 out of the 3.
Correct.
Right?
Yeah.
So the third gentleman is...
Gadi, will you let everybody introduce themselves again, you in particular, because you haven't met the full committee and the committee hasn't met you. Please.
Yeah, press the button.
There you go. Green light. Red light, no good. Hello, everybody. I'm Gadi Kaufman. I'm extremely honored personally to be here and to meet you all for the second time. First time was about 6 months ago when we were, our contract was approved. We are delighted and humbled to help the CalSTRS board make good real estate decisions and make sure that the portfolio is moving in the right direction strategically and that the management team is driving the portfolio to the expected results or better without taking undue risk. We take that responsibility very seriously. We believe greatly in the mission of helping you in achieving that goal and are conscious of the fact that all of our efforts are aiming towards achieving the investment returns in order to support the requirements of the plan to help or to fund obligations to the retired teachers of California. So thank you for the opportunity and thank you for having us here. I'm Gadi Kaufman. I'm CEO of RCLCO. I've been with RCLCO since 1979 after graduating from UCLA. And I have been the CEO since the late 1980s. And our company is dedicated to providing advice and only advice to all real estate operations, from investment to development to enterprises that are servicing the industry.
Well, I think everyone's met you and as well as,
The mission end. We got to hang on the mission end.
yeah, so we can get right into the semi-annual.
Perfect.
Yep.
Well, following on Alan's point of view, you have the reports in front of you, including the one-pager, so we'll try not to be redundant with it. The highlight and the headline is that real estate, as is the economy, are now in a very long upcycle, and it is getting late in the cycle. These are times when all actors become quite frothy, and the market from a pricing valuation point of view appears to be very fully priced. So with respect to overarching advice that we render to all of our clients, and I think it's something that would be relevant to CalSTRS as well, the advice is hold on to the assets that are really dear to you. Use as little leverage as possible, because during the downturn, leverage is working in a negative way towards accretion of value and accretion of returns. And then unload any assets that are not going to be desirable to own in the long term. So if you have anything in the portfolio that you don't really think you're going to love in 5 or 10 years, or in 2 or 3 years if there's a downturn, this would be a good time to sell it while valuation is high. We don't have the crystal ball. We don't know when the downturn will hit. We do believe that cycles have not been eradicated from our economy, and that the U.S. economy, the global economy, and real estate markets in both those environments will suffer from a downturn all in time. So being ready for the downturn makes a lot of sense. In the meantime, it does not imply that one should not be investing at all. On the contrary, one should be investing during all stages of the cycle. It is a matter of investing wisely and investing in assets that are in platforms that are truly durable, that have good long-term potential, that are irreplicable investments. Anything that doesn't meet those 3 criteria probably does not want to be allocated capital from the plan. And the good news is that the report that ends the period of September 30th, 2017, so it's almost 8 months old now, shows very good performance, where the plan, its managers, its investors, and the staff have outperformed the benchmark and have performed quite well as far as accomplishing total return, both in current income and in value growth. The portfolio seems to be in good position. The management team is focused on the right questions and issues, and at the headline, we are very comfortable with what we're learning as we go along. We are new. We have only joined your teams this year, starting in January. So we're still learning our way around the portfolio and the management team and the boardroom, and we hope to continue to be to learn more and be as responsive as we could be to your needs and to the needs of the plan. Tiller, would you mind spending a few minutes on some of the particulars?
Yeah, of course. And following Alan and Gadi's advice not to necessarily rehash what you see on a monthly basis, will certainly highlight that the real estate portfolio is performing, particularly the active portfolio, that which has been invested since 2010 is significantly exceeding benchmarks and remains in compliance with the strategic parameters relative to risk profile and debt. We view our role as board consultants as providing information regarding opportunities and challenges facing the real estate portfolio, suggesting that in clear and, importantly, actionable ways, and considering on occasion, when appropriate, what we would do if we were in your shoes as board members in order to effectively resource and guide policy, but also the staff of real estate. And so that's really what we'd like to focus on today, are some initial observations that we have given just a few months that we have on the job. And picking up upon what Gadi was saying, it's important to emphasize that real estate has been in one of the longest periods of expansion since World War II, essentially. In order to evaluate performance going forward, we need to understand essentially where 2 different markets are within the real estate space. There's the market for space, just renting space, buying houses, and so on, and the market for deals, the market for investments, which are two separate markets that we pay attention to. The market for space is really pretty solid. The fundamentals are quite good given significant discipline, really a memory hangover from the Great Recession that has kept lenders disciplined and construction, therefore, relatively limited. There may be some distress in the near term, but it's really localized, really asset-specific more than anything else in particular geographies. And we expect to see, and I think most observers of the space expect to see medium-term positive, though moderating, NOI growth, net income growth driven by properties. Then there's the market for investments, which is a little more complicated at this point in time. And what we're seeing are essentially counteracting trends in real estate investment space. There are, first of all, unprecedented levels of demand for real estate investments as institutional investors everywhere around the world are increasing their allocation to real estate and having a difficult time finding quality transactions. And so that's keeping pricing high. At the same time, and Chris mentioned this in his remarks as well, there is significant upward pressure on cap rates, which are the predominant valuation metric that is used to value real estate assets, given increased expectations regarding inflation, increased expectations regarding interest rates as well. And so that is putting downward pressure on real estate pricing. And so nobody really knows where that ends up, but it likely suggests that despite the fact that over the past few years we've seen decreasing cap rates, which drives increasing valuations of real estate, we're likely to see that flatten or maybe even reverse somewhat going forward. And overall, that suggests that appreciation of assets, which is one of the two components of value, is unlikely to have significant positive impacts on returns of the real estate portfolio going forward. We think that's important to recognize and highlight. The market seems to agree with that assessment as well, as we included in our report the PREA forecast, which includes investors and consultants from around the country. The really good news, no matter what happens to the CalSTRS portfolio, given where we are in the cycle, is that CalSTRS has generated much greater control over its investment activity than it had at a previous time in previous cycles. 61% of CalSTRS unfunded commitments to real estate are in vehicles that it controls, where it has control over the going in of investments and to a large degree, control over the asset management of those investments and dispositions as well. We should, which gives CalSTRS a great position as distress potentially enters the markets. We have identified in our report some challenges and risks that you should be aware of that may impact the portfolio going forward, both external and internal. And before we highlight these risks, we should point out that based upon our interactions with staff, which have been both frequent as well as candid and deep, our observation as staff is both aware, highly aware, and focused on these risks and items. None of this would be a surprise to them that we're mentioning it. And we're really highlighting it to you so that we can engage in an ongoing conversation with board members, with staff, with the other consultants as well as to how to address these potential challenges in coming months and years. First of all, focusing on external risks. We've mentioned the economic cycle already. We have to be aware of the likelihood of deteriorating returns, which will primarily be driven by a lack of appreciation of assets. These are returns on paper that are driven by appraisals and valuations of the existing assets, not necessarily income, but they will be impacting performance going forward is our expectation. Interest rates as well, which we've talked about. It's not as big of a concern for the portfolio given the significant deleveraging that has taken place in the portfolio, but is important for the assets that do have leverage and is important to valuation as well. And like all segments of society, we are seeing and experiencing significant changes in terms of how people are using real estate that is affecting certain properties, certain property types, certain geographies, and so on. We're all living this ourselves on a day-to-day basis as we change how we get around cities, how we travel, how we rent space, and so on. And so that creates risks within the portfolio as well. And then finally, it's important to highlight internal areas, internal to staff, internal to CalSTRS, that we believe merit discussion in order to enhance real estate performance going forward. In the interest of time and I think prioritization, I'm going to highlight two. I think the first is planning and pacing, which really involves ongoing movement toward strategic goals that are set. And our observation is that the real estate team has been appropriately driven by significant high-level goals to drive performance. Those have included lower leverage, increased control, maintaining diversification appropriately, and they've been extraordinarily successful in achieving these goals. Based on conversations we've had with staff over the past few months, we think this could be enhanced by purposeful routine planning around those goals in order to set priority, particularly given limited amounts of time, limited staffing for the significant opportunities that the staff has. Related to staff, that really is the second item that we think is worth mentioning. As CalSTRS has gained greater control over its investment decisions over the last few years within the real estate portfolio, as it's been moving out of commingled funds, which really give no discretion to separate accounts and other vehicles that do, staff has been placed under much greater demands of time and capacity in order to effectively underwrite individual investment opportunities and evaluate new opportunities that are coming to CalSTRS given its reputation in the market, given its scale, and given its history of doing innovative things as well. We think this is the right direction for the real estate staff, the real estate portfolio. Moving toward greater control over investments gives you much greater transparency into asset performance and drives significant economic advantages through fee savings and so on. But it is going to require greater staff capacity going forward, both in terms of numbers and specific abilities as well. We therefore think we should engage in a longer-term conversation about how to effectively staff the real estate team given these important goals of greater control and transparency. We've highlighted other strategic opportunities and goals that should be addressed in we think periodic planning processes in the report, but in the interest of time can discuss those in later sessions and informal conversations as well. But just want to summarize that our initial observations as new consultants to CalSTRS is that the team truly has worked diligently and effectively over the last few years to stabilize the portfolio. It is well positioned to weather any challenges that may arise, that will likely inevitably arise. And this allows the CalSTRS portfolio and team to not just survive potential distress in the real estate markets, but to thrive and take advantage of them as well. And we look forward to playing a role in that process as well. So we'll leave it to any questions if we still have time for that, but appreciate the time we've had.
Thank you, Taylor. Do we have a few questions or comments? Steve?
Thank you, Chairman Kiley, and thank you for the presentation. If I were to give you my simplified takeaway from what you've told us over these last 10, 15 minutes, it's that that there's out in the horizon a storm coming, that there's going to be a downturn, and that probably before we see an uptick in the real estate market. So notwithstanding the notion that we should continue to invest through all cycles, I'm curious why we wouldn't, and I'll look at Chris, slow down at least our investment to work through that inevitable downturn, and then once we get into the downturn, find those investments where it makes sense for us to be in, and then increase our investment in real estate.
You said much better what I was trying to say earlier, which was to be extremely selective about the investments that are made now, only invest in very durable assets or companies, and otherwise pass on other opportunities. The implied result of that would be a lower investment pace, most likely. And then the dry powder comment that you made is very well reflected in the portfolio. The allocation of capital has a significant amount of dry powder in it, billions of dollars available to move at an opportunity when it comes along. That capital will not likely be fully invested in the next year or two, even if the downturn doesn't occur for a year or two. So built into the structure, into the fund, and into the decisions about allocation of capital is already a substantial amount of dry powder to take advantage of those
I would
opportunities.
just like to remind everyone, we do have opportunity in closed session where we might talk a little bit more in specifics around strategy and opportunity. So just a friendly reminder to everyone.
And then let me just close with both a gratuitous and inappropriate comment. You mentioned your alma mater, and all I have to say is go Bruins.
Go Bruins, thank you. No. We're brothers, we're all brothers.
If I can add just a part, Steve, you raise the age-old problem. You hear me say a lot that we don't want to chase targets. So the target for real estate is 13. I don't want Mike and team investing without regard to price. Price matters. And buying buildings at very low cap rates is not proven to be a very effective strategy. Then again, we know we can't market time. We know we can't pick the perfect cycle. So as Dave said, we're trying to sit on buildings that we like. We're selling the ones where people offer us what we think offer us extreme, ridiculous prices. Then we'll let those go. And if anything, you'll hear a common strategy in all the asset classes. As I said in the asset allocation, we're neutral, but we're leaning defensive. So real estate's newer transactions tend to be debt related, more conservative. You know, when buildings are just priced at levels that we think are absurd, we're not going to chase those prices and try and have some discipline. But we also know to the asset allocation, you don't want us to market time and take it down to 6%. So it's an interesting dynamic of trying to invest through markets, but be smart about price.
Thank you.
It's Dana.
So I appreciate your caution that some of this might be more appropriately discussed in closed session. So I'm thinking this first question might be that way, but I'm going to put it out there. So Mike, you have some time to think about it.
Mike's still contemplating on Chris's suggestion to be disciplined.
There you go. In the write-up, it talks about that there was an increase in the allocation of core assets, and that's due to the liquidation of our legacy portfolio, and it went from 13% to 8% in a year's time. So we reduced it by 5%. But we're also expecting to liquidate more, but not increase the core allocation more, but we want to take it down another 7% in a year's time. So I'm curious as how you think you might be able to do that, and what, if it's not going to be, if those aren't allocated to core, what other, are they going to be value add? Are they opportunistic? I mean, their legacy, I don't know. So is that more appropriate for closed because it gets into strategy? Alrighty. So now, Mike, you have a heads up to formulate an answer. And then my question to you all is, the real estate market's approaching late stable mature phases, product types, and geographies. Do you have some examples, and how will that then play into us continuing to invest in real estate over this upcoming storm?
Sure. So the question is specifically about what geographies, what property types might be further along in the cycle. Yeah, the number one example is likely multifamily, for example, which has experienced more significant growth during the last several years, and is likely approaching peak pricing. The cap rates for multifamily have fallen dramatically over the past few years, and are now at levels where the spreads between what debt you can get to leverage a particular property and what NOI you can generate are very narrow. And so we do expect that to stabilize, perhaps expand going forward, impacting valuations. At the same time, the market fundamentals for multifamily and for housing in general continue to be very positive over the long term, which illustrates again this challenge between what's happening on the capital market side and what's happening on the property market side. As you know, in California, we continue to face housing shortages in most markets within California, and it's extreme in California, and the affordability challenge in California and in many other markets is really driven by supply beyond anything else, that there just simply isn't enough. And California is not unique in this challenge, and more cities across the country are facing it as it's difficult to produce new housing. And so we do expect the long-term fundamentals to be good. So that therefore suggests we don't want to stop, or CalSTRS should stop investing in multifamily, but it should be paying very close attention to pricing. And there are several markets in the country where that might be the case too. The Bay Area would be one of them, where pricing is extreme for real estate assets. Austin, New York City, and so on. There are other property types, just really briefly, that seem to be facing more structural challenges. Retail would be one of those. All of us have changed how we shop for everything at this point in time, and all types of retail are facing challenges, again, both on valuation, but also in terms of market fundamentals, the number of tenants that can afford to pay rent at this point in time. That doesn't mean it's all going away, but it does require being very selective. There will be winners, and there will be a lot more losers than there have been in the past.
Just to add to that, one other sector within real estate that is facing a secular decline in demand is also the office sector, where you have greater acceptance of telecommuting, greater acceptance of co-working space, lower square footage utilization per an employee. So as a result, that decreases the demand for office space. And that's relevant to CalSTRS because more than a third of the portfolio is allocated to the office sector. And it's one of the highlights, the challenges that we highlighted in our report that should be discussed in part of the strategy going forward.
Thank you.
Yeah, I've heard some interesting conversations about parking spaces and in traditional office buildings and what will happen with those spaces in the future. Not for now, but it's maybe over a couple of
We could go on and on.
Yeah, we won't, which we won't. So, Dana, anything else?
Nope, that doesn't.
Betty?
Thanks, Harry. So with respect to pricing, are you seeing yet, particularly in coastal locales, the pricing in of risks like sea level rise and climate change effects?
That's a great question, and the answer is no for the most part. There are a handful of submarkets, but really neighborhoods in places like South Florida that are starting to experience today the impacts of sea level rise through higher tides, more frequent tides, and so on. And what's impacting the investment market is now the difficulty to insure certain properties and get bank financing. But in investable submarkets, so parts of Miami where CalSTRS might actually own a building, parts of New York that might be impacted by stronger storms and so on, there is no impact that we're seeing on pricing at this time, and that's largely because I believe the investment market is counting on the public sector, because the public sector in many instances is making commitments to address the impacts of climate change through creating larger seawalls, through requiring higher streets and changing infrastructure requirements. And that really is where investments are being impacted, is through additional costs as a result of regulation that is changing requirements about where electricity infrastructure can be placed within buildings and so on.
Okay, thank you.
Seeing no one else in the queue, thank you, gentlemen.
Thank you. Thank you. Thank you.
Brings us to 19C, Semi-Annual Performance Report for Private Equity. John Haggerty and Steve Hart from Makita.
Thank you.
Okay, well, first a comment to pick up on the prior comment about pricing in the real estate market is we could echo those same comments in many regards, and it's very much on our mind, especially as we discuss pacing. The metric for pricing in the private equity market is a measure of price to EBITDA, a measure of earnings, and that's currently at its peak as well. The one difference that we see in the current market, which is very, very strong and very highly priced, is that the leverage that's being used is a little bit less, and that's not quite at peak. The average deal is about 45% equity versus peak moments when it was about 40%. Our presentation here will speak to the snapshot in time of September 30th for the private equity program, but also speak to a number of the issues that are very important for the private equity program with regard pacing, and inevitably the subject of pacing brings up questions about pricing and continual disciplined deployment into this market. So I'll start with the first slide. The next. Okay. All right. As is the case in prior quarters, right around 70% with buyouts. That pretty much matches the market structure, and that's no surprise. If you were right at the market structure, you would have a little bit less in buyouts. You have more in buyouts because you have less in venture capital. U.S. continues to be out about 2/3 of your exposure. When you look at it on a currency basis, because a number of your emerging market strategies are denominated in dollars, that figure 66 goes up to about 86. As we've noted many times in the past, the vintage year exposure that you have pre-global financial crisis is quite large. About 40% of total private equity commitments is in those 4 vintage years, and the subsequent vintage years are somewhat smaller and underrepresented. The performance has moved very minimally over this period of time. It's improved by 10 basis points since inception. There was a very nice dollar increase in this portfolio, so capital appreciation was $1.5 billion roughly. The performance remains mixed relative to the various benchmarks that we use. Of course, we use a customized peer benchmark that matches the vintage year exposures and the structure of your portfolio with respect to buyout and venture capital. With respect to that customized private equity peer benchmark, the performance was very close, but below publicly traded stocks, that benchmark, the performance range remains below that. As we've mentioned a number of times, that the measure of PME, which shows what you would have had you invested every cash flow into the private equity program, into the stock market, you have significant gains since the inception of this program by running this program. Activity, this gets to the pacing question that I mentioned earlier. For this period of time, this is the 6 months preceding September 30th of 17, there was net positive cash flow. This has since turned in the other direction, but for that period of time, almost $1 billion more came out of the portfolio than went into the portfolio. This is a period of time when there was a lot of selling activity by your managers. And we note here as a counterpoint to that, the second bullet point, that during the second half of 2017, staff was fairly active in making significant commitments, $2.8 billion in commitments, and 2.1 of that was made just during the fourth quarter alone. So staff is very busy and mindful of the long-term targets and is aggressively seeking to hit those targets. Here we show some of the major statistics for the program, just shy of $18 billion at the end of September 17. This equated to, at that time, 7.7%. Here we show the benchmark at that time at 9%. It's since been dropped to 8%, and also gains in the portfolio have put the private equity program pretty much right on the interim target for private equity. And then with respect to the target ranges that are established, each of the different categories by strategy, buyout, venture capital, were within the range with the exception of special mandates, which was at 7%. just slightly above the 0 to 5% range that's been established. And that will slowly come down with time as less funding will go into that sector and will receive distributions, reducing that market value to within the range. To reiterate some of those points, diversification very strong, and within the portfolio, the statistics on the percentages I quoted earlier, just slightly below the interim target. It was January 1 when the current target was lowered to 8% from 9%, and the long-term target remains 13% for the portfolio. As mentioned earlier, your currency exposure is quite a bit more than the 66% in US that I mentioned earlier to US dollars, and that's the result of your emerging market strategies more or less being denominated in the US dollars. The primary exposure that you have is to US companies, and in second place being Europe, as we'd expect, at roughly 20% of the portfolio. And with that, I'll leave it to Steve to cover the more detail, the cash flows of the program.
Yep, so this is an update to a chart that we've provided historically. And I think we just kind of focus on two aspects, just highlighting what John had said previously, that we're starting to see a turnaround of how the net cash flows are working, and seeing that in the recent couple of years that the amount of distributions has started to come down, and you can see just barely that the amount of contributions are starting to pick up, so that we're seeing that from a cash flow perspective, seeing some more capital starting to go into the program. I think we've talked about before, largely this seems to be a result of the lots of commitments that were made in the 2005, 6, and 7 time period, where those are being returned back, and relatively light commitments in the 2008 through 2012 time period. So just allowing that to kind of catch up. And then also we'll talk about a little bit further that there's been further commitments in the program in the last year or so, but also increasing the pace of co-investments, which helps step up the actual pace of dollars going out. But overall, in the last 3 years or so, about $8 billion of net cash has come back to the program. All that's good, but it doesn't help the program sort of get larger in size from the $17, $18 billion it was. Although John mentioned, this has just started to turn around in the last several months. In terms of performance, you see here the numbers going across from the 1 year through the 10 year. Generally, all the numbers have ticked up since the last time we presented to you, in the range of about 100 basis points, although the 1 year is up a little bit stronger than that. On a since inception basis, it's gone up about 10 basis points. The 10 year has actually gone down a little bit. I think it's really just sort of a function of the endpoint bias, kind of where that had started. And I think to Alan's point earlier, that this number will start to show significantly stronger results as we kind of lead past those years of 2007 and 8. We have adopted a new benchmark, the customized State Street Private Equity Index, and you can see in there that the performance against that benchmark is quite close to the program. The program and the benchmark are quite close there, and that's, I think, effectively showing how the program, when you adjust for some of the aspects of vintage pacing and target sector allocation, that we see some more comparable representation there. And noting that against the custom benchmark, it's a little difficult, lots of customs here, but the custom benchmark is really a public equities index with a extra return of 300 basis points that given the strong performance of the public equity markets, particularly through September, make it a difficult a target to try to achieve. So I talked about the points here, slight underperformance, the 1 year returns. would say has moved up meaningfully from the 8.4% one-year return back in from September 2016. When we last reported to you before, that one-year return was 14%. Again, not to necessarily focus on the 1 year, but it's just showing that the private equity program continues to show some improvement in performance. That's all we have in terms of the presentations here. But we do, as you know, we have talked about pacing. We could talk about that further. We've talked about the planned value versus the public equities program. We've talked about the benchmarking. And I think in the future, we're talking about how the additional strategies and new emphasis that the staff is taking towards some other areas, including more co-investments, more separate accounts, that there's additional creativity there and items there that we can continue to focus on going forward.
Thanks, Steve. Steve Juarez has a question.
Yeah. Thank you, Chairman Keeley, excuse me. So I just wanted to, something you said caught my attention, which was the fall-off year of 2008, the impact that's going to have on overall returns. I would have assumed that in private equity, the impact of that year wasn't nearly as great as it was on the public equity markets, but correct me if I'm wrong.
So you're right that the amount, the drawdown amount, the amount that had gone down is going to be less, but directionally it's going to be the same. That we're going to see, you would see if you look at returns from that time period, that number will show a negative return. Might not be as steep as what you had seen in the public equity markets, but directionally it would be the same. And then as that changed around, it would become positive again. A reason for that is that a large portion of the portfolios, even though they're unrealized, managers typically look to the public markets to try to do comparable values of their underlying portfolio companies. If that company had been public, what would it be competitors look like? Are those values there based upon what the stock market values is for those companies? And so that gets reflected into the values of the unrealized portfolio, and that impacts the value.
When do we officially shed that year?
So the performance we reported here is through September of 2017. So the next time we'll report to you would be March numbers. That would be the 10-year anniversary. March 2008 would be kind of the lowest point of the marketplace, as I recall. So I think after that, when we get back into September, sort of a year from now, I think that's when you would see in the private markets area where you might see the uptick taking place.
Chris? Yeah, March 9th of 2009 was, sorry to correct you, Steve, was the low of the market. So in the public markets, you'll start to see it a year from now, but you won't pick it up at the June 30 numbers, and it won't be until just barely December of next year we'll start to see it. But for them, it'll actually be a year and a half before we start to see it. Both real estate and private equity will continue to be lagged. And private equity is going to suffer even in that comparison because obviously the level of central bank stimulus around the world from 2009 till now is just unprecedented, and it has caused public markets to just really do well. But obviously all the private markets, real estate, private equity, everything has just really struggled to catch up until here in the last part of this decade since 2009. So I think the public market comparison will always be tough until we get to maybe a normal central bank balance sheet time period where there's not so much federal easing.
Thank you, John. Thanks, Steve. Jennifer, item 14, do we have any information requests? I don't think so, right? Item 15 is the draft agenda for July 19th meeting, 2018. It's relatively straightforward. Chris, you want to highlight one or two issues? Thanks.
We're going to add the investment beliefs back on, probably the consent, because we're going to have it proofread by an outside reader and get complete sentences done, because we are the teacher's son. And then we're going to add the corporate governance 30 and 30 review that Aisha mentioned of what they did. We'll probably put that in information item in open session for discussion. We'll have the 10-year business plans. We made those, and they are an action item. We made them very short, so they'll be condensed, so we won't spend a lot of time on that. But we will try and spend more time on some of the other issues, the collaborative model. We have been trying for 2.5 years to get somebody from the San Francisco Federal Reserve to come speak to us. Now I understand our problem because John Taylor got hired as the New York Bank federal governor. So, but we are going to have Elizabeth Latterman from the San Francisco Federal Reserve Office come and talk to us about interest rates. So I'm really looking forward to that because it's been such a struggle to bring somebody in.
That's it. If, we have some public comments. We're at the time of the day where we'll hear public comments. After public comments, we'll take a break, and then we'll come back to closed session. So, public comments. Jim Baker, private equity stakeholder project. Toys R Us, Bain Capital, and KKR. Jim, welcome.
You already have this, right?
Yes, thanks. Is Jim's mic on over there?
Look at the guys behind you.
They'll fix it for you, Jim. Hold on.
Thanks. Thank you. Good afternoon, Mr. Chair, members of the board, or the committee, rather. My name is Jim Baker with the Private Equity Stakeholder Project, also here on behalf of the Center for Popular Democracy and Organization United for Respect, which work with retail workers. As you may know, private equity firms KKR and Bain Capital, as well as real estate firm Vornado Realty Trust, own retailer Toys R Us, or owned retailer Toys R Us, which filed for bankruptcy late last year and recently announced it is liquidating, closing all of its stores and laying off 33,000 employees. On March 15th, Toys R Us sent a letter to employees informing them that their employment will be terminated on May 14th, 2018, next week. And that the company will not be paying severance to laid off employees. Meanwhile, Bloomberg reported last year that KKR, Bain Capital, and Vornado collected more than $470 million in fees and interest payments from Toys R Us over the life of their investment. On April 23rd, 10 Toys R Us employees from around the U.S. sent a letter to KKR, Bain, and Vornado asking them to pay severance to workers out of the $470 million in fees and interest that they took from Toys R Us. In the letter, which is in the packet I handed out, it reads, we love our jobs and have devoted years of our lives to serving Toys R Us and Toys R Us customers. Some of us have worked for Toys R Us for decades. We recently learned that Toys R Us will not be paying severance to employees. We also learned that your companies, Bain Capital, Colbert Kravitz Roberts, and Vornado Realty Trust, which were responsible for piling on billions of dollars in debt that drove Toys R Us into bankruptcy, took more than $470 million in fees and interest payments over the last several years. Taking hundreds of millions of dollars from Toys R Us and then refusing to pay severance to employees is a disgrace. The $470 million that Bain Capital, KKR, and Vornado Realty Trust took from Toys R Us works out to more than $15,000 per worker, more than enough to pay a fair severance to employees. In addition, more than 50,000 Toys R Us employees and their supporters have signed petitions in support of KKR, Bain, and Vornado paying severance. Unlike Toys R Us workers, KKR, Bain Capital, and Vornado are not struggling. KKR founders Henry Kravis and George Roberts took home a combined $343 million last year. Both are billionaires worth over $5 billion each. CalSTRS is a significant investor with both Bain Capital and KKR and owns a small stake in Vornado, although is not directly invested in the funds that own Toys R Us. We've reached out to the three companies multiple times, but none has responded. And so we asked that CalSTRS contact Bain Capital, KKR, and Vornado and ask them to pay a fair severance to Toys R Us employees. Thank you.
Thanks, Jim. Thanks for bringing this to our attention. Juan, our next speakers are Juan Chavez. And Jim, if you haven't seen the CNBC story when Toys R Us announced bankruptcy, Becky quit, Andrew Ross-Saukian and Joe Kernan got into a great exchange about the whole issue of Toys R Us. So if you haven't seen it, check it out. Juan Chavez, Mitra Ellie, Ian Lewis, and William Rodriguez.
Thank you, board members. Ian Lewis with the Hotel and Restaurant Workers Local 2. I'm here to talk about, as you know, the Pullman Hotel in Redwood City. And I'd sincerely hope to come here with some news that the deteriorating situation had taken a turn for the better. Unfortunately, your investment manager, CBRE Strategic Partners, has so far been unable to hold accountable its own hotel managers to an agreement, and particularly their hotel managers want to silence their employees in making public comment about their experience at this hotel and attempting to organize. While disappointing, this isn't quite surprising to us. The HEI, this company that manages your hotel, CBRE's hotel, has continued to escalate a program to intimidate workers, as you'll hear in a moment. And workers themselves have been taking it upon themselves to organize actions outside the hotel, in the employee cafeteria, even in the lobby of the hotel, especially in light of the discussion that you just had with respect to real estate strategy and that you will have in closed session. I think this really draws to your attention the importance of hiring investment managers who can really hold their own managers accountable to the best interests of those assets of your fund, especially at the late stage in the life cycle of this fund. A deteriorating labor, a growing labor dispute could have real consequences for your assets and for your investment, not to mention the scores of workers who are daily impacted by this. There are just 3 workers, I know it's been a long day, but 3 workers who took today off who you've heard from before, but who really want to update you on what's happening. And again, as this goes forward, I thank you for your attention to this, and I urge you to keep this situation in mind as you make further decisions. Thanks.
Good afternoon, board members and staff. My name is Mitra Ellie. I'm a phone operator at the Pullman Hotel in Redwood City. After coming here in April, I sincerely really hoped that would have been our last visit. Since then, things have just gotten worse and really bad. Me and my coworkers, especially the union leading workers, are being targeted. For example, I've had the same work schedule for the last 2 years. I had Sundays off. They decided to change the schedule and not tell me, and then call me in the office when I didn't show up for work. They didn't let me know they changed the schedule. That's not right. I don't know if it went in my record, but that's another story. Sorry. They usually post the schedule on Thursdays. They haven't been doing it till Friday. When I left work on Friday, it wasn't even up, so there was no way that I would have known that they changed it, even if I looked at the schedule, like they told me to. The next day, they called me in the office and gave me a warning for not showing up for work. I was also told that there was a representative from CalSTRS at the hotel recently. I don't know if he spoke to any employees, but I wish I could have talked to them. I would have told them about my body pain and aches from repetitive stress injuries every day. I would have told them about going above and beyond for this company without even a thank you. I would have told them I've had to move twice in the last 3 months because I couldn't afford it. My parents still have to help me. I would have told them about being a long-term, full-time, and loyal employee for a wealthy company and not even making enough money to live on my own. Most importantly, I would have told them I'm not going away. I'm not going to give up. I hope CBRE and their managers know that I will continue to fight for my own well-being as well as my coworkers. Thank you.
Good afternoon, board members and staff. My name is Juan Chavez. By now, I'm probably a familiar face to many of you guys. It's been 6 times since I've been here, representing myself and my coworkers at the Pullman Hotel. Last time I was here, I told you about the fear that me and my coworkers feel every time we speak up. It's only gotten worse within the last 2 months. Managers called the cops on us during a picket line. I couldn't believe that the managers would call the cops on their own employees. We are the people who come every day, wash dishes, clean rooms, stock up the freezers. Why are they treating us like criminals and thieves instead of the hard workers that we are? Union leaders, like myself, have been targeted since coming out as members of the union committee. The general manager has been looking for any mistakes to discipline me. They've called me into the office many times this whole week, telling me to just keep my head down and shut up, pretty much. It hurts to be told that I'm not doing my job when I do all of my job, plus help other people, whoever need it. Last week, the stress and the pressure, it was too much. I had a panic attack at work. I almost collapsed. When the paramedics got there, they wanted me to take the ambulance. I had to refuse the ambulance because I knew it would be too much to pay that bill. I ended up driving myself home because managers wouldn't let my coworkers drive me. They put their own liability policy above my life. That's why managers how can I expect them to act in good faith without a card check neutrality? Tomorrow will be exactly 1 year since I delivered a petition to CBRE in San Francisco asking for a fair process. After a year of empty promises, it feels like they're just stringing us along. They say one thing and do another. It's time to demand action, not just empty promises. Thank you guys so much. I hope this is the last time I come. Thank you.
Good afternoon, board members and staff. My name is William Rodriguez, and I am a server at the Pullman Hotel for the last 16 years. I am here because I see that so far, CBRE, the owners who have taken over the Pullman Hotel, and their management company, HEI, have been giving us nothing but broken promises and empty words. When they took over, we were told that nothing would change for us employees and everything would remain the same. On the contrary, I have seen 29 of my co-workers laid off or fired for no fault of theirs. Our health insurance have gotten worse and they make us pay more money. In the past 1 year, we have seen 6 general managers changing. It's a total chaos. There have been 3 or more wage and hour claims because the HR department have been taking out unauthorized deductions from our paychecks. There have been errors in paychecks, and when we approached them for a resolution, they were not able to resolve it. In my case, it took them more than 6 weeks to resolve and give me whatever money they have been taking out. And for this reason, I have to go to the labor board to file a wage claim. We cannot count on them. The hotel management is just promising but not delivering anything. We cannot count on the hotel or their owners. They don't seem to be acting as responsible business partners with your money that you have invested too. So we need a card neutrality agreement as soon as possible, and for this, we plead with you and we need your help to push CBRE and their management company, HEI, to give us a card neutrality agreement as soon as possible. Thank you for your attention and have a great afternoon.
Sure.
The union's been coming here every single month for a long time. I sent staff over there, including a Spanish-speaking staff. They were not able to verify any of these claims. All of these claims are worthy of the National Labor Relations Board, obviously San Francisco. We have not been able to verify all these claims. So not that these people aren't telling you the truth, but we're looking into it. We had CBRE and the management company here today. They did want to come and talk, but for whatever reason, we sent them away. I guess you probably don't want a union fight with management here in front of you, but look, guys, we've looked into this as much as we can. We have been offered a confidential ballot, and it's a negotiation, a labor negotiation between whether it's card check or a confidential ballot. We have been told by legal that we're not allowed to get in the middle of that. We're only an LP in this agreement. CBRE has gotten all the pressure we can put on them. And they're not hearing it just from us, but from other people. I'll continue to send staff over there to talk directly to the employees to validate these claims, because I know you're concerned about them. We're exhausted. We've tried everything we can do. I would prefer that we sell this hotel and never invest in hotels again about these kinds of things, but CBRE is trying to resolve this management dispute. They are in negotiations. It's the best I can tell you, and we'll continue to devote resources to drive over there and meet with employees and verify firsthand for ourselves what's going on. But that does divert resources away from the other things we do.
Thanks. Steve?
Yeah, thank you, Chairman Keeley. And this is probably more for the people that spoke. Is there an outstanding claim with the National Labor Relations Board that we're familiar with? So there's one outstanding and being looked at against either CBRE or Pullman?
There is an outstanding claim with the Department of the Labor Standards. It's a California wage and hour claim in this particular case related to payments that are I believe over 6 months overdue at this point. I don't have the specifics on that claim, but that is outstanding, yes.
Paul?
So a couple of things. First of all, I was interested by what Chris just said, that legal has said that as LPs we really can't get involved in this. So we just adopted an updated ESG policy that basically says that our ESG policies apply as much to our private asset classes as to when we own a publicly traded company. So I wonder, this may not be the time to do it, but it seems that then legal interpretation makes it very difficult for us to actually carry out that ESG policy in our private asset classes.
Paul, I think you understand it's always complex. In our private asset classes, in new investments after today, we will include this new ESG policy as a side letter agreement, so our partners acknowledge our 21 risk factors and new investment going forward from today. In an existing investment such as this, our policy did not get down to the question of card check versus private ballot. And that's where you always have a real struggle. Whenever somebody is trying to expand their level of influence, they come here. Our policy is very clear. We are to be labor neutral, and we are not being labor neutral. We're crossing the line, and it's always very tough on us to figure out how we be labor neutral. I know many of you would prefer us not to be, which is why we're trying to be supportive. But that's where the policy says we're labor neutral, and that's where the lawyers have told us we have to be.
Well, I mean, reading from the risk factors, it says that we are to consider the right of.
Paul, I'm going to interrupt you for a second.
No,
the item is not on the agenda, and I don't think we should be engaged in a discussion.
That's why I started by saying I'm not sure this is the right time to talk about it.
It's not.
But I would like to talk about this because I think it raises some questions about how we can implement this. And I agree, let's not talk about it now. I would like to see if we could schedule this for some other time. I'd also like the gentleman who spoke on Toys R Us asked us to ask the 3 companies to pay severance, and I don't know Did we give him an answer? Do we plan to give him an answer on that?
We heard the request. I
Right.
think we should probably get some guidance from governance. If we had every person come before us and make a request and then publicly make a decision without any deliberation, any conference with our legal counsel, I think that would be a really slippery slope for us to go into. I would prefer that we maybe in closed session, it's a specific request, it's about a specific relationship, about a specific manager, that we receive some guidance from people that are advisors to us so that we make the most prudent decision consistent with our duty of loyalty to the CalSTRS pension fund.
And
So I
I
heard
would-
the request. I think it's, and I don't want to get into a match with, an argument with you here on the dais because I think it's inappropriate.
I wasn't suggesting we give him an answer. I was asking, are we going to give him an answer?
I don't know if we know the answer to that yet.
Okay, well.
I don't think we know.
Well, no, I mean, I think he made a request. We should at least acknowledge that we'll get back to him in response to his request or something like that. If we can just do that.
Jim Baker, someone on staff will reply to you. You're welcome. Thanks, Paul.
Thank you.
Sure. And perhaps, maybe, I just think Amy's here and certainly legal counsel's here. Maybe we can get some clarity. I could use some clarity and some guidance on how to manage these types of issues so that we're consistent with what our responsibilities are and being appropriately responsive to people that come to us that want us to become involved actively or passively to assert our influence. And I would certainly welcome some guidance from legal counsel and from our governance team, because I could use some assistance with that, because it's sometimes a very gray area as to what we should and should not be engaged in. Is that clear? Thanks. Thanks, Brian. Appreciate it. In other words, I was asking for some help. I need help. Thanks. I think as a group, we need some help because we want to do the right thing, consistent with what our responsibilities are. So thanks. Steve.
Yeah, in light of what Brian reported on putting language on organizational neutrality, my question about the NLRB was to clarify that union organization isn't what's at issue here. It's really the treatment of workers that are already unionized. Is that correct? No. Or are there?
No, it's union organization. They're not unionized. And my comment was related to how workers are treated, which obviously even ununionized workers have rights. So I've been concerned about the allegations of treatment of people and these descriptions, and that's what we've been trying to hold management accountable.
So they're not currently organized at the Pullman?
Correct.
Okay. All right. I don't know if the gentleman wanted to answer or not.
That's okay. That's okay. You can let Mr. Juarez know.
That's fine. No, I got the answer to my question.
Great. Which brings us to the end of the public comments. This issue, when it was first brought to our attention, we asked our staff to communicate clearly with our partners at CBRE that we expect anyone we do business with to treat their employees with respect and dignity. I've had the opportunity to speak to a senior person at CBRE. I have no doubt that from that person's perch, they are committed to making sure that workers are treated with respect and dignity. I don't want to get into the details of what's happening at the Pullman because they have a side of the story. I would caution us to getting into that level of detail inside of our investment committee meetings. Okay, with that, we'll adjourn public session and we will come back at 3:30 in closed session. Thanks.